Good Super Bowl Monday morning, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, a pharma fight. Novo Nordisk rebounds as Hims and Hers pull a copycat version of its Wegovy weight loss pill.
And Alphabet tapping debt markets for about $15 billion, adding to the AI investment borrowing boom.
Plus, China urges banks to curb their treasuries exposure, while Goldman tells traders to buckle up for the week ahead. And yet, we don't really have a lot of massive movement.
No, I mean, if you look at what the S&P did yesterday, by the end of the week, it had barely moved. It was like nothing even happened.
Yeah, even though all the things. China says stay away from treasuries.
Right.
Another Mag 7 company taking on loads of debt.
Yeah, you'd read the headlines and you'd be like, are we in a bear market? What's happening? One area where there is some movement, and there has been a lot, is this whole ongoing drama between Hims and Hers and Novo. So Novo Nordisk said that it's suing Hims and Hers for making a knockoff version of its obesity medication that they were going to charge less than $50 for. But Hims and Hers scrapped that because, one, the threat from Novo, and two, the FDA saying we're not going to allow any of this copycat obesity medication on the market.
That's right, and like forwarding the email to the Department of Justice.
Right.
So that makes you back away pretty quickly. Shares of Kroger are rising in the pre-market after the company named ex-Walmart executive Greg Foran as its next CEO after nearly a year-long search. And for those of you who don't live near a Kroger or know, this is the largest grocery store chain in America. I mean, that's focused solely on groceries, right, Dani? Because, you know, Walmart still is bigger.
I actually didn't realize that. I've only ever been to one Kroger in my entire life in Southern Virginia. I don't know really where else.
Did you get the best of everything, including the price?
Sure. I'm sure I did, Matt. And if not, I'll have a word with you, Kroger. Let's begin with Novo Nordisk suing Hims and Hers, accusing the telehealth firm of infringing its U.S. patent on key ingredient in Ozempic and Wegovy. Let's get the latest with Sam Fuseli. He's the senior pharmaceutical analyst at Bloomberg Intelligence. Sam, we were just talking on Friday, and you were telling us there is a danger to this. This isn't good. It sounds like Hims and Hers has finally listened to some of the criticism and threats coming from regulators.
Yeah, well, Dani, the point here is not about one company listening to another, to regulators. There is law. There is international law. You are not allowed to copy a drug that is still covered by a patent in the jurisdiction that you're selling the drug. Novo Nordisk's drugs are covered by a patent. That is the rule of law. You can't just go ahead and copy that. Whether it's safe or not safe, I know that is not incidental. Of course, it's not good if it's not safe, but it's just not the way that things work. Generic companies create a whole set of trials, compare drugs to the product that they want to compete with, then go to the FDA for approval. Here's a company that's just making them in the pharmacy, selling them to people. It's just not right. And I think finally we're seeing some logic creep into the system.
I'm here to tell you, Sam, don't put too much faith in international law these days. I'm looking at Eli Lilly shares versus Novo, and this is, I guess, a good day for Novo, but Lilly has absolutely trounced this stock, even though Novo Nordisk invented this whole sector of drugs. Where did they lose the edge? Where did Novo go wrong, and how has Lilly been able to dominate?
Yeah, so Lilly had two things going for it. One, they had a really good device when it was just in the diabetes space. And that device really helped them in terms of the injection pen. That really helped them get some good momentum. And then they took a gamble on this tirzepatide molecule. That's not, everyone calls them GLP-1s, but tirzepatide or Mounjaro, Zepbound is not just the GLP-1, it's two actions, GLP-1 and GIP. Nobody expected the GIP part of it to do what it did in the end, which is what has resulted in a product that beat Wegovy in a head-to-head trial. It's got better efficacy, higher efficacy, better weight loss, similar kind of side effect profile. So that, along with a good pen, and I'm not saying that Novo doesn't have a good pen, but everything lined up. And there's one other element here. Lilly has been in the business of selling products to the mass market type settings. Novo has been mostly specialist endocrinologists, if you like, diabetes specialists. So that perhaps has played into this as well. But Novo now has got itself a a new head of US, which I think we'll see how that impacts things.
All right, Sam Fazeli there at Bloomberg Intelligence. Really appreciate your work. I can confirm also that the Novo pen is fine. Doesn't hurt, works well. Turning to tech, Alphabet is kicking off a 7-part bond sale, adding to a borrowing spree by companies at the forefront of the AI investment boom that is supposed to scare us off, but doesn't seem to be doing that in the case of Alphabet shares. Okay, they're down 0.7%, but they've tripled in 5 years, and they're clobbering Microsoft and Amazon. Joining us to talk about this is Caroline Hyde, co-host of Bloomberg Tech. So it's a gigantic company. I guess no one's really worried about $15 billion of borrowing.
And at the same time, they're tapping the Swiss market and the sterling market. In fact, they're looking to sell a really rare 100-year sterling bond as well. So Alphabet is out there across every type of part of the debt market. Alphabet Infineon, the chip maker in Germany, just tapped the bond market very successfully over in Europe as well. You've just got hot on the heels of Oracle having sold $25 billion of debt at the beginning of last week. They got $129 billion of demand, a record set. You might be bracing for $400 billion of investment-grade debt coming to finance AI. That's what JP Morgan thinks we're going to be getting. Thus far, the pricing is enough to tempt people in. And everyone's saying, look, Bloomberg Intelligence is saying Google or Alphabet, the parent company, has a rock-solid AA credit rating. It is best in class in terms of its overall balance sheet. You don't need to worry here.
The idea of a 100-year bond for one of these hyperscalers is crazy to me because we don't even know what the next 3 years is going to look like, let alone 100 years. Maybe it's safe for Google to be doing this, for Alphabet to be doing this because of its cash and its balance sheet.
Yes.
But for the likes of Oracle, for these companies that are starting to go through some real cash burn, how are they still staying afloat? How are investors not completely revolting against them right now as they had been to end the last year?
I guess they pay enough. So it's enough that there is just this wall of demand that in the debt markets, yes, we've all been talking about equity. Everyone's been demanding so much of Oracle, Amazon, Alphabet, all of the hyperscalers and cloud providers equity. But the debt markets only get to tap in on these new issuances every year or so. Infineon's coming for the first time in a year. No wonder everyone wants to have the wall of opportunity to be buying in on this AI trade across the capital structure. And for now, it seems as though the price point, even though BI is saying, if you're looking at Alphabet, for example, they think you could maybe see the bond market, the yields come in about 40 basis points, but they're pricing them pretty on the nose for Alphabet. They obviously clearly got a syndicate issuance vibe from their banks that the demand is there. They don't have to suddenly go way over treasuries. You're looking about 125 basis points at the longer end. But as the year progresses, maybe you start to see these companies have to pay up more. Maybe you see pressure on the issuance of older bonds. Remember, Oracle was actually taken to task by some of its bondholders. They were sued by saying, look, when you first tapped for $18 billion at the end of last year, you never made clear you were going to be coming time and time again. We didn't realize you were going to be financing this much in AI infrastructure, and they got a suing tap on their wrist, whether or not who wins out on that particular fight. But clearly Oracle then, when they issued last week, really were very clear on this is how we see our year going. This is the only time we're going to be tapping this year. And overall, you're starting to see companies having to be really transparent about the amount. No, I mean, they kitchen sinked it. It was a mic drop last week. $200 billion is how much Amazon's going to be spending. $185 billion is what Alphabet's going to be spending. They're being very clear with investors how much they need to get.
I mean, and Oracle got off another $25 billion last week with $200 billion of demand. So, they could shoot somebody in Fifth Avenue, and they would still be able to sell these bonds. I want to ask about Apple, the new iPhone 17e apparently coming on. I read Mark Gurman's reporting last night. So what do we know about the new product offerings?
Imminent. Yeah. Yes, you're going to get the magnetic BIC on the back to be able to help your charging. Yes, you're going to be getting the A19 chip inside, and you'll be getting some better chips that they make internally for wireless connectivity. But more broadly, it's kind of like the 16e. But a little bit of an upgrade. And the idea that they know that demand is there. They're really going to be going for the emerging markets. They're really going to be going for corporate buyers in this particular phone.
The E is the cheaper phone.
But basically, the marketing is, it's got everything inside. Look, I've got a 16e, because when I walked into Apple, they were like, well, if you're not a photographic genius, this is exactly all you need. You're still going to be able to use Apple Intelligence as and when it gets to us. And you're going to be able to have all of the memory that you currently need. So a lot of people are liking these slightly cheaper, really high-end phones. And remember, Samsung is just really going for the top end of the market at the moment. We haven't seen that much of an upgrade, which we're likely to get from Google Pixel. Their phone isn't going to have many bells and whistles being built on. So they're kind of in a league of their own at the moment. Apple can just keep on cashing in on this demand for their latest phones.
Caroline, thank you very much for joining us this morning. Bloomberg Tech co-host Caroline Hyde-Catcher at 11 a.m. on Bloomberg Tech. Let's turn to this bond market because yields have started to retreat after something curious this morning. National Economic Council Director Kevin Hassett said that we should expect slightly lower job numbers on Wednesday. Joining us is Bloomberg macro strategist Michael Ball. Michael, there were a lot of reasons for yields to be drifting higher this morning, between what China had been talking about of telling banks to back off, between what's happening in Japanese markets. What do you make now, adding Kevin Hassett's comments into the mix?
Yeah, I think he's talking about the demographic shifts and trying to set a tone now that expectations are lower, that we're not in this Biden era where we should expect 100, 150,000 to be the norm. Instead, now a flat number would be around 40 to 60, which is what we've seen from sell-side research, and it's not going to be really news. It's just an admission that we're in a slower job growth world, and it's not necessarily worrying if these numbers don't come in. Now, markets may disagree with that, and we certainly are watching that closely to see where the gauge is for the break-even number.
I hear so much about this Sell America trade that supposedly is on, the debasement trade, and yet it doesn't really seem to be coming through, right? We're still at under 422 on the 10-year yield.
Right, and that tells you everything you need to know, the price action itself. But also, we look at the tick data, or we look at the indirect bids at the auctions. None of it's flashing any worries. And to be honest, China's been reducing its Treasury holdings for some time. And this looks more like some sort of regulatory risk management exercise than an actual message to the American administration about geopolitics or the trade negotiations going on right now. So I don't take too much worry in it. And finally, just China really wants lending to go to the consumer, to boost the domestic economy. They're very worried that they put this policy backdrop in place and yet nothing is happening. It's pushing on a string still.
All right, Michael, thanks so much for joining us. Bloomberg's macro strategist, Michael Ball. You can check out his work and the work of his team by typing MLIV-GO on your Bloomberg terminal. In terms of futures, after the bounce back that we got on Friday, a little bit of a sell-off here today, and I stress little bit. The Dow, S&P futures, down 0.25%. NASDAQ futures down about 0.4%. Let me go ahead and look up, because we don't have the Dow Jones Industrial Average for you here, and we'll start playing that throughout the day because of the 50,000 mark that we overcame on Friday. Right now, Dow futures down 0.2%.
Dow did well, equal weight did well. It's the old school rest of the index coming back. Coming up on the show, Apollo sets a lending record in a push to rival Wall Street. We're going to get the details for you as those shares move higher by nearly 4%. That's coming up next. Stay with us on Open Interest.
Let's get now to high interest. Look what's making headlines around the world. China's President Xi Jinping faces a choice after Japan's new Prime Minister, Sanae Takaichi, won an historic landslide victory. Beijing can keep economic pressure on Tokyo over her Taiwan comments or seek a reset. Takaichi has implied that a Chinese invasion of Taiwan could prompt Japan to deploy its military. And while the new prime minister says she wants stable ties, she also said she won't back down on security, raising stakes for China, Japan, and the U.S. Tuition for New York City private schools has now crossed the $70,000 mark at several of the elite schools here in the city. The median tuition is up nearly 5%, far outpacing inflation, driven by higher teacher salaries and operating costs, while millions are being offered in financial aid. Even high-earning families say the sticker shock is growing. And Ferrari has revealed the interior of its first electric car, co-designed with former Apple design chief Jony Ive. It is called the Ferrari Luce. It rejects giant screens and autonomy hype, favoring tactile switches, physical controls, and driver-focused experience. Ferrari says more details, including the exterior, are coming later this year.
In your review, what do you think?
I mean, it looks pretty good, but it does look pretty iPad-ish. And I mean, I'm open-minded because it's a Ferrari. It's going to be amazing. But I prefer a manual transmission, a naturally aspirated motor.
Yeah, I was going to say, if someone brought you this car and was like, here you go, Matt, I'm sure you would not say no.
Be very happy. I'm glad they have an analog clock there.
Yes. Yes, bring back analog clocks. Matt, elsewhere, another story we're tracking today. Apollo has set a record in its business of making loans. The company originated $97 billion in the fourth quarter. It's pushing to become the largest underwriter on Wall Street. Let's get more with Silas Brown, Bloomberg senior private credit reporter. Silas, this comes back. I remember there's this FT story on private credit, and they quoted someone from Apollo saying, "We're becoming a bank and it sucks." I feel like that's also what this earnings kind of tilts its hat to.
Yeah, I mean, look, I think Apollo is often lumped in with other private credit or private capital providers, but actually the way that they originate their assets, I mean, due to the nature of Athene and other insurance providers that they own, is somewhat different, and actually it means that they have a lot more capacity to lend to more investment grade portions of the sector, and I think, I mean, not knowing precisely where their lending records have come from, I would assume that a lot of it comes from these kind of large ticket private investment grades deals that they've been doing more and more.
So Apollo also announced a deal with Schroders. Not all American investors will know, but obviously legendary in London. Doing something that a lot of these big firms are getting into a business a lot of these big firms are trying to crack into, and that is, I guess, high net worth individual or family office wealth management. How do you think this is being received?
Yeah, look, I mean, I think it's somewhat of a classic partnership. I mean, there are several. Apollo has done others as well, like L&G and Blackstone and KKR and Capital Group. I mean, I guess the kind of general thought process behind it is that there are these big beasts like Schroders and L&G that have these networks of wealthy clients, but also pension relationships and things like that. And then there are these kind of great origination beasts like Apollo and KKR. And so that's kind of, I guess, the thought process behind it. I think with the Schroders one, it seems to be quite an expansive relationship. They have tie-ups on the public side and the public and private fixed income portions, which is kind of bigger than other tie-ups that have come out.
So it's one of the things that Mark Rohn, the CEO of Apollo, just said on the earnings call, saying our software exposure in PE and Athene is near zero. If that's true, and I'm assuming it is because he said it, is that kind of remarkable? I thought software was a pretty loved asset class by private capital across the board, and for Apollo to come out of the wreckage last week saying we have basically nothing, is that unusual, or is that common among their big publicly listed peers?
Well, so not having listened to the great Mark Rohn speak in his earnings thing yet, I think I would say no. I mean, we did a story last week about private capital software exposure, and I think Apollo had taken a view early on, kind of earlier than some peers, about a sort of bearishness around software, particularly due to the rapid adoption of AI. And so I think if my memory serves me right, it's in the story, they cut some of their exposure from 20% to about 10% last year. And I think some of their leading kind of players like John Zito have been quite public about their bearishness on software. I think they are. I mean, there are others that I think are more bearish, but I don't think that's a broadly held view across private capital.
Silas, great to catch up with you as usual. Hope you have a fantastic week. Silas Brown there covers private assets for us out of London. Coming up, Keith Lerner of Truist sees market leadership broadening in the U.S. and abroad. He joins us to talk about that next. This is Bloomberg Open Interest.
Goldman's trading desk has warned that stocks face more selling this week from trend following algorithmic funds, or CTAs, writing in a note, quote, the inability to transfer risk quickly lends itself to a choppier intraday tape and delays stabilization in overall price action. Buckle up. Joining us now is Truist CIO and Chief Market Strategist Keith Lerner. Keith, great to see you this morning. This piece on the terminal has been remarkably well read because I think everybody is digging through, I don't know, wreckage is extreme, but digging through the volatility of last week that ended us down only 0.1% and thinking, is there more to come? How are you thinking about last week and what it means going forward?
Yeah, well, Dani, great to start the week with you guys. I think last week, if you zoom out beyond the headlines, it was a really interesting week because below the surface, we had a very strong market and a very cyclical tilted market, meaning look what we had by the end of last week. We had small caps, and I'm looking at the S&P 600 at a fresh 52-week high, mid caps at a fresh 52-week high, the equal weight index at a fresh 52-week high, the international markets at 52-week highs. So you have this transfer from tech into the broader market. And that was really the story last week beyond the headlines and the sell-off that we're seeing in software.
I wonder if you expect the sell-off to continue or if that was it, Keith, because it was crazy volatile, but it looks like a lot of investors have bought the dip and brought us back to levels where we were before.
Yeah, I would say, Matt, the key I would look for this week is on tech. We went right to that 200-day moving average and bounced off of it last week. I think that's a positive sign. So listen, I think it will be maybe a choppy week, but I think the underlying trend still deserves the benefit of the doubt. And again, the way the stocks are acting, they are buying into this economic uptick, which is also our base case.
All right, Keith, you're going to stay with us, and after we get to the open, that's Keith Lerner of Truist with your opening bell less than 5 minutes away. You are looking at an equity market that is down after recovering. Friday was the S&P's strongest day in 8 months. It rallied nearly 2%. You give a little bit of that back this morning, down 0.25%. Kevin Hassett warning that the jobs numbers might not be that strong this week is bad news again. Tech underperforms, down 0.4%. Equal weight, that hit a new record on Friday. The Dow crossed 50,000 for the first time ever. So to Keith's point, there has been a broadening out. We'll talk more about that when we come back. And we'll be back with your open after this commercial break.
We are moments away from the start of trading on this. It's a Monday morning, and typically, especially after the Super Bowl, you'd be kind of bleary-eyed and sleepy, maybe a little hungover. But wake up, because Sydney Sweeney is ringing the opening bell at the New York Stock Exchange, along with American Eagle, everybody wearing their denim there, the star of, what's the new movie she's in, The Housemaid or something like that?
Oh, yeah.
It's an awful movie, but I love Sydney Sweeney, and not because she's so beautiful, she's really into cars. I think she was on Jim Farley's podcast. She has a Mustang and a Bronco. And she works on them herself, so that's why she needs the denim. Anyway, good reason to be happy today. Also, American Eagle stock, by the way, it's up 60% in the last 12 months. So they have been crushing it for a retailer. Zebra Therapeutics, another company that's really been on the comeback trail. If you look at the 5-year chart, they're still down 5 or 6%. But over the last year, they've gained 10% back. Over the last 2 years, 40%. Over the last 3 years, 60%. So they're really coming back over at Zebra.
It's just hard to compete when the rival opening bell's got Sydney Sweeney at it.
That's true.
I kind of feel bad for Zebra this morning. Not a lot of
I'm
people
pretty excited for all the traders on the floor of the New York Stock Exchange.
Oh my, I fear for Sydney Sweeney. I hope she makes it through unscathed. Matt, I'm looking at shares of Novo Nordisk and Hims and Hers this morning. The drama continues. Novo Nordisk said that it was suing Hims and Hers for making a knockoff of its obesity medicine. Hims said that they have scrapped plans to sell a copyright version of the Wegovy pill because the regulators also got involved. So Hims really struggling this morning. Novo gets a pop of about 5 1/3%, Matt.
We're watching shares of Kroger as well after the grocery store chain named ex-Walmart executive Greg Foran as its next CEO after nearly a year-long search. I know that he has plans to try and make the stores cleaner and, I guess, lower prices. It all seems pretty obvious, but that's what they're looking to do.
Friendly.
And
that was
and
like
more
he made them more friendly and
right.
nice.
I mean, as a boy from the great state of Ohio, where we used to frequent the Kroger,
right?
It seemed pretty clean and very friendly.
Yeah,
obviously.
But doesn't Walmart have mandated happy greeters that smile when you come in? I don't know if Kroger goes that far.
Yeah, no, I never saw any greeters at Kroger, but I haven't been there in a while.
Yeah, neither
right?
have I.
There aren't any around here.
Yeah, good point. Yeah. So.
Maybe they should move back to New York. Truist CIO and Chief Market Strategist Keith Lerner is back with us here. And Keith, we haven't mentioned much that the Dow Jones Industrial Average went over 50,000 on Friday. When I was a kid, that would have been like headline news, Wall Street Journal, front page. Does it not really matter that much anymore?
It still matters, but I think in some ways, kind of where we started our conversation, like the move up, this kind of broadening trade that we're seeing domestically and globally has got lost somewhat because we're seeing like the S&P 500, which has such a concentration in tech, be relatively flat, where underneath the surface, you're seeing some really, good action for the overall market. So it still matters, but maybe a little bit less than when you and I were a bit younger and I had some black hair.
And I had hair at all.
I'm sure someone still out there has made a 50K Dow hat that everyone's pouncing around wearing. Keith, away from the company news, the macro news has not been great. The jobs data we got last week was pretty lousy. We're going to get another jobs figure delayed on Wednesday. And Kevin Hassett of the NEC is out saying expect a jobs number that might disappoint. If we do continue to get jobs data that disappoints, is this an equity market that's going to sell off alongside a rally in bonds?
Yeah, well, I think initially, Dani, the way I'm thinking about it is the jobs data at this point is somewhat lagging. We know we have this kind of fiscal punch coming through or stimulus in this first quarter. And the market is clearly saying that it believes, look at transports making a fresh high along with the Dow Jones as well. So, I guess that is the risk. If you really start to see more of a meaningful slowdown in the economy and this perceived disconnect between GDP growth and labor really further expand. But I would say our base case is that we actually will start to see some stabilization in the labor side. And also, we are seeing some productivity gains as well. So I think that comes into the equation, the immigration, the AI stuff. So I think the jobs market by itself is just it's more nuanced today, and the market is clearly sending a signal of economic growth.
Well, it seems like it matters less and less, like the Dow, maybe. We had a great conversation with Rick Reeder about this on Friday, and he pointed out, like the people that are at risk in the jobs market just aren't as important to GDP growth. As you're mentioning as well, Keith, right? Because we've got high net worth individuals doing all the spending, the giant, hyperscalers doing all the capex. The government is pouring stimulus into this economy. So even if we get larger unemployment, it's not going to mean a slowdown in GDP. And frankly, the interest rate tool isn't as effective. How important is the Fed for this market?
In the near term, I don't think it's the main driver. I think corporate profits are the main driver. That's the North Star of this bull market that we've been speaking about over the last year. And what we're seeing is forward earning estimates for the S&P are at a record high. But what's important is we're seeing that broaden to small caps and mid caps. We're seeing strength there. But we're also seeing that international emerging markets just had a strong uptick. And Matt, maybe one comment on the job market as well. I know a lot of times we focus a lot on how much job growth there is from month to month. What's really important in our view is we have about 160 million people working in this country. And what's really key for the economy to move forward is that wage growth stays above inflation. And right now, that's still what we're seeing.
Keith, one of the more cyclical parts of this market that's had a really good run has been regional banks. They gained every single day last week, which in itself was a feat considering what the rest of the market did. It's now trading at a record high. There's consolidation, there's M&A. Would you be adding to this sector?
We're more neutral to the overall financial sector. And as you mentioned, some of these areas have had a big move in a short period of time. So I think we would be more likely looking at pullbacks as opposed to aggressively adding here. But I will say that it does fit into this global trade, also a steepening of the yield curve and the M&A that you mentioned. These are all things that typically will bode well for the regional banks. And that's why you're seeing that strong price action also.
In terms of, the big movers, the gold, the Bitcoin, I guess software ETFs, is there anything, Keith, that you think hasn't recovered yet that the market's overlooking, maybe we should buy?
Yeah, well, on gold, we actually downgraded gold last Thursday morning near the highs. And we think there's going to be some time element with gold after being about 40% above its 200-day moving average. So that's going to take some more time. We still think structural drivers are there. On the software side, Matt, I think it's going to be one of the things where almost like gold, but the other side where the rubber band keeps getting stretched, and you'll have a snapback. I don't think it's going to be leadership because it's something that's hard to disprove, even though the earning trends are relatively well. It's just getting a bit overdone. So at this point, I will say more broadly on tech, even though we have burned out our sector exposure, I would not give up on tech. Tech's multiple has moved down from about a 32 to about a 23 multiple. So a pretty sharp reset on fears in general, where the earning trends are still the strongest in the market. So I would say broadening, but don't forget about tech. I think there will be a point later this year where tech comes back in vogue.
Keith, I just wonder if something about last week, almost ending where we started, to be honest, is instructive, not necessarily in terms of the fundamentals of software or what's happening in the jobs market, but between correlations in this market. When you get volatility in things like gold and silver, and to Matt's point, what Bitcoin did, you add that in, and then its impact on equity markets. Does it show some sort of underlying sensitivity in this equity market that itself might cause more volatility?
Yeah, no doubt. I mean, some of these areas which they have different, you think profit trends are not even, earnings related are looking the same. If you overlay a chart of software and Bitcoin, it looks like the same chart. So yes, I just think, and I think that's we're going to kind of see this concentration of moves that kind of seem like, why are they moving together? But there's also some leverage plays. And we also know, even like on Reddit, we know that, silver and gold were two of the hottest trending tickers, which 6 months ago, that would have been crypto. So I do think that's a change in the market dynamic where things that seem uncorrelated become very correlated. But I would keep my eyes on those underlying earnings, which over time I think will be reflected in stock prices.
Keith, thank you so much for joining us this morning. It's great to kick off the week with you. That's Keith Lerner of Truist. Let's get a check on your equity market right now, almost 10 minutes into your trading day, and we are flat to slightly down. The breath isn't great. We're down 316 stocks are down for nearly 200 being up. To the upside, you have some of the big tech names. NVIDIA is doing well, Microsoft, Eli Lilly after a new deal to buy a biopharmaceutical company, Oracle. That's seeing its biggest intraday gain since December. Shares are up 8.5%. Not totally sure what's going on there. It did get a sell side upgrade, so maybe that's helping to drive it. On the downside, you do have Apple. We were just talking with Caroline Hyde earlier in the show about how they're going to be debuting one of their new cheaper phones. Amazon, that continues to fall after announcing a huge amount of spend in their earnings last week. Shares down 2.4%. Micron, Intel. So not a great day for the chip makers. And you will see some of the damage, even though the chip makers aren't doing well. Infotech is still at the top of the pile because of that NVIDIA move. Energy, that also picks up, but most of these sectors are down this morning. Consumer discretionary, Amazon lives in this category, so that's why it's down 1.3%. GM is down a lot today. It's actually the worst performing consumer discretionary stock. I'm not totally sure why that is either, but utilities, real estate, staples also not doing well. So some of those safety sectors not providing a lot of safety this morning, Matt.
I'm looking at, by the way, at Oracle. I mean, it's come down by so much.
True.
Since it reached a high, like in September of last year, it's down still more than 50%. So any buy here is not going to get you back to where it was. Coming up, Novo Nordisk. Speaking of stocks that have come down drastically and are now on the move higher, fires back, suing hims and hers over obesity drug copycats. We'll explore what it means for patients next. This is Bloomberg Open Interest.
After the best day for the S&P of this year on Friday, we try to continue those gains. We're now unchanged on the S&P 500. NASDAQ falls 0.1%. Let's get you some top calls to analyst action that we are watching this morning. First up, D.A. Davidson. They upgrade Oracle to buy, saying that OpenAI is likely to exceed investor expectations, and that's going to directly benefit Oracle. Oracle, a huge rally, maybe off the back of that, up 9.33%. Very jumpy market where small things seem to be moving equities a lot. Next up, Wolf Research, they upgrade Robinhood, saying that the app will see upside from the growth of prediction markets. The analysts say the stock looks more attractive after recent pullbacks, even with weaker crypto trading. Those shares up 4.4%. Next up, Roth Capital, they upgrade Roblox to a buy after its latest earnings. The analysts there say that they have a positive view of the business based on stronger than expected bookings guidance. Shares, Matt, up 8.7% this morning.
All right, so big gain there for Roblox. Novo Nordisk also looking at a big gain. It is suing hims and hers, accusing the telehealth firm of infringing its U.S. patent on the key ingredient in Ozempic and Wegovy. Meanwhile, Eli Lilly agreed to buy Orna Therapeutics for up to $2.4 billion in cash as the company expands its pipeline beyond its blockbuster obesity drug Zepbound. Joining us now is Bloomberg Health reporter Madison Mueller. So, Madison, a lot going on for you on this Monday morning. Let's talk first about Hims and Hers. I guess you could have seen this coming. Why were they so bold in making that move to begin with?
I mean, they were so bold because really up to this point, they've been able to get away with this. I mean, Hims has been selling compounded versions of Novo's weight loss drugs for the last 2 years, really without any repercussions. I mean, Novo, Lilly, they've spoken out about this compounding issue, but as for the FDA and US regulators, they really haven't done much to crack down on this sort of copycat gray market. And so this was the bet that they've taken, that would just continue, that regulators wouldn't do anything about it, that Novo wouldn't take steps to sue them. And then we've sort of seen it all crashing down in the last week as a result.
What degree is it just crashing down for Hims and Hers versus the entire compounding pharmacy market? Because there's still a lot out there. Exactly. I mean, I don't know if theirs are compounding or not, but like Ro, for example, having Super Bowl ads, I'd assume some of their stuff is compounding pharmaceutical medicals.
They did do compounding at first, and then they pulled back on it. They sort of saw where this was headed, I think, a little bit earlier than Hims. And so Ro has been able to work with both Lilly and Novo to offer discounted versions of the brand name drugs on their platform. So they have a better relationship with them. But there are still, you're exactly right, there are still compounding pharmacies, there are still other telehealth companies, there are still med spas that are selling these compounded products. And it's been really hard for the FDA, or maybe they just haven't prioritize this quite enough because they have a lot of other things going on, that they really haven't done much to stop this market from proliferating.
I always look at a 5-year chart of stocks on the Bloomberg terminal, just because the comp function defaults to that. And I think it's a fair window to look at performance. Novo Nordisk has underperformed Eli Lilly by 413%. And that's really only started in the middle of 2024. Is there any way that they come back and catch up, or is Eli Lilly's tirzepatide, their Zepbound, really that much better than Wegovy or Ozempic?
It is better. I mean, the drug is better, plain and simple, and
better
that
in
has
terms
been a
of
huge advantage.
Losing more weight.
Yes, more effective, also potentially less side effects. So a lot of times if people are having a lot of side effects on Wegovy, their doctor will switch them to Zepbound. At the same time, Lilly has a deeper pipeline than Novo. So in terms of next generation therapies, they're ahead there too. Novo was really pinning its comeback hopes on this pill that Hims launched a copycat version of, a couple weeks after launch, and that's why it was such a big deal. Because Lilly has a pill that's coming in a couple of months, but Novo's had quite a bit of a head start. A few months head start makes a big difference. And so that is really important for them, and staying ahead in this pill market is going to be important, but we don't know if they'll be able to catch up.
By the way, as you know, I think like the pill doesn't make much sense. If you can do the shot only once a week, why would you want to take the pill every single day? And I struggle to use the term shot because it's not like a painful, it's not like a needle, right? Where the compounding pharmacies, you have to stick yourself with a syringe. This is, easy. I know that there are other companies working on drugs that last even longer, so you would only have to take it once every quarter.
Yeah.
How far away are we from that?
Yeah, we have a couple of different companies, Pfizer and Amgen, that are working on less frequent dosing. The interesting thing is that it sort of comes down to patient preference. I mean, when it comes to the pills, some people just don't like injections, which, like you said, it doesn't really, it's not a full like shot, like a vaccine that you're getting. It's different, it's a smaller needle, you don't really see it. But some people just prefer pills. Some people prefer less frequent dosing, but some people don't, because then you're maybe not as conscious about it. So that's something we've seen with diabetes, that people actually prefer maybe more frequent dosing because then they're thinking about it, they're monitoring it, they're also thinking about what they're putting in their body, exercise, other things that go along with it. So it sort of just comes down to patient and doctor preference. But drug makers are sort of betting on the idea that having more options is not a bad thing, and having all of these different options in the market at the end of the day is going to benefit patients.
Never a dull moment in this space.
Exactly.
Madison, thank you so much for joining us. That's Bloomberg's Madison Moeller. Coming up, Kroger taps a former Wall Street executive to lead the grocer. That's coming up next. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks right now, about 25 minutes into the session. You're going to see a lot of red here, but it's not so bad, right? S&P 500 down, but only 0.1%, 69.24, the level there. The NASDAQ also down by just about as much, still over 25,000 on the NASDAQ. You see the small caps falling further in Bitcoin, back down to under 70,000, so $69,345 a share. Take a look at Nvidia right now, up 3.5%, so that's holding us back from steeper losses. Oracle, as we've been talking about, up almost 10%, a 9% gain here on Oracle after an analyst upgrade. And of course, it had such a successful week last week. Hims and Hers is down. It's lost a quarter of its value now that it won't be able to, or now that it's pulled the pill version of its copycat Wegovy drug. Novo Nordisk bouncing back about 6%. You can see Apollo right now up 3% on earnings and a couple of announcements, one of which is with a team up, a partnership with Schroders, and then Kroger, which we're going to talk about right now, up 7% and change, Dani, on a new CEO.
So that new CEO, it's a retail veteran named Greg Foran. Let's discuss it because he comes from Walmart, and clearly the reaction is positive. Emily Cohn, she leads Bloomberg consumer coverage, joins us now. Emily, what do we know about Greg, and why would this be such a positive thing for Kroger?
Thanks, Dani. Yeah, Greg was once called the greatest retailer on the planet by Walmart's former CEO, Doug McMillon. He's known as an operator. He's known as someone who really gets grocery and retail. He is the person who was in charge of Walmart US during the mid-2010s when Walmart's really started to prioritize making the stores feel cleaner and friendlier, and the groceries got better. A lot of the things that Walmart is really benefiting from right now, as we see a lot of growth there, especially from higher income households who are shopping at Walmart.
Can he really do this at Kroger? Because Walmart is a different kind of store, right? I mean, we were talking today about the fact that Kroger is apparently the biggest grocery chain in America. And I thought, well, Walmart's bigger. And someone said, but that's not the same thing.
That was me.
Okay, there you go.
I think you nailed it. When you think of Walmart, it's Walmart. Of course, they have their e-commerce business and their stores, but everything's Walmart. Kroger is a chain of many chains.
At Walmart, you can get a bicycle, you know, a bow and arrow.
Kroger owns Ralph's. They own a lot of different grocery chains across the country. I think running, an umbrella of many businesses is probably a lot different than running one chain where everyone knows what Walmart is. It'll be interesting to see what he does.
Is there any outlook for more consolidation in this space post all the Albertson kerfuffle, new administration, maybe easier to get some of that through? Right. Are we expecting anything?
Right. It's a good question. We know that Kroger was trying to do that with its acquisition of Albertsons. Obviously, that didn't work, and then they lost their CEO. But it does. You raise a good point. It does sort of indicate what this chain might be looking to do. I don't know what their plans are.
By the way, Kroger. I grew up near Kroger because I'm from Columbus, Ohio, thankfully. But then I had to move here for work. And there's no Kroger here. I noticed there's also no Walmart. Is there something about New York City that these successful national chains just want to avoid?
It's true. I mean, I think both Kroger and Walmart really rely on large retail footprints, which is just nearly impossible here. The labor environment here in New York City is, of course, very different. But what you do see now, and I see it more and more, is that the doorsteps in my apartment building in New York City, you see Walmart delivery boxes. People can get Walmart deliveries as fast as they can get them from Amazon. And that's Walmart's new frontier. So maybe they don't need a big box in New York City, but they can deliver.
Right on. All right, Emily Cohn covers retail for us on the BN side. Coming up in the next hour, Kelly Covley of Manning and Napier on risks to the labor market, and Edgewell CEO Rod Little following his company's latest earnings report. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Equity markets unable to hang on to gains after a big rally on Friday in an insane week where we ended only down 0.1% for the S&P.
Yeah, a round trip. Coming up, China urges banks to curb their treasuries exposure while Goldman tells traders to buckle up for the week ahead.
Apollo sets a lending record, a key signal in its push to become one of Wall Street's biggest underwriting forces.
Plus, American activist investor takes on one of Switzerland's most iconic companies. Stephen Wood discusses his campaign to shake up the Swatch Group.
We begin with caution on Wall Street ahead of a busy week of economic reports. That includes the January jobs report and inflation data. Joining us now is Kelly Covley, Senior Investment Analyst at Manning & Napier. Kelly, thank you so much for joining us. I mean, of course we're going to have a busy week because last week was so calm and chill and nothing happened. How are you thinking about specifically the economic data of jobs numbers coming in with last week, some of the data not being great, and now add to that NEC Director Kevin Hassett saying maybe you should expect some lower numbers?
Sure, and Hassett's comment, I think, really was a long-term, forward-looking comment that because of the decline in immigration, we should expect non-farm payroll growth to be a little bit lower. The immigration was running at 2 to 3 million people per year coming in from 2022 to 2024, and the recent estimate from Brookings has it for 2025 at 0 or even below. So those 100,000 plus numbers you were getting on non-farm payrolls, I think it's safe to no longer expect that. Even if you get kind of this 0 to 50,000, you might still be able to keep the unemployment rate constant. But the more concerning side is this low hiring environment we've been in for quite some time. It's a delicate balance because you have hiring low, and again, that's okay with this low break-even payroll growth, but if you do get layoffs, those can have a disproportionate impact on unemployment because the workers who need to look for jobs will have a harder time getting one.
So Joe Bruce-Wallace writes in, he's an economist at RSM, and he says it's also boomer retirement that's contributing to lower job growth. It's also large firms ending the hoarding of labor that we saw, during the post-pandemic period, and productivity decisions based on, AI can do more, so why hire these people? How much is that latter issue really a concern right now?
I think it's difficult to tease out because the generative AI boom really started right around the time when the Fed had hiked rates really aggressively in 2022. And after that, that's when we saw that real drop-off in hiring. And it's difficult to tease out, looking at the broad numbers, how much of that is from AI. People have pointed to the unemployment rate for college grads as evidence that these newer workers are being more replaced by AI. But I would also say that these are workers who disproportionately need to find a job. They haven't had one. They're not employed because they're being educated. So when they come out into an environment where there's just not a lot of hiring going on, I think it makes sense to see them kind of with that higher unemployment rate.
What about the other AI threat? And that is the software SaaS-pocalypse that occurred last week. Is now a time to be looking through portfolios and thinking what is going to be disrupted?
Yeah, and I think a lot of these names will be disrupted. Last week we had, I think, a little bit of a sell now and ask questions later mindset in the software space. And that is really the flip side of what we saw last year with the hyperscalers, which was a buy now and ask questions later. So I think it's healthy that the market is asking these questions, but the software side, I think there are probably some babies being thrown out with the bathwater, if you will. Companies who sell to enterprises, it's a high bar to replace software that is integrated into a really complicated tech stack, and I think that can buy some of the software companies sometimes to adapt and even maybe benefit from AI themselves.
So it seems like it's interesting that Kevin Hassett comes out and points to essentially Trump policy that's holding job growth down, because obviously the president has capped immigration or stopped immigration. He's also put tariffs on, goods coming into the U.S., which I guess has hurt manufacturing. We saw a drop of like 70,000 manufacturing jobs in 2025. The idea was to bring manufacturing back, right? Not to stop it. Is that going to happen this year, Kelly?
I want to give them some credit. Manufacturing had a rough go of it for the past couple of years. The ISM
decades.
Decades
right? The past
too,
couple
yes.
of decades. But the whole idea was these tariffs are going to bring manufacturing back to our shores, not continue to reduce manufacturing jobs.
Yeah, I think it's not something that can happen overnight. It takes time to build capacity. And I do think there's just going to be an issue of the labor here is more expensive. We've seen where there are the most stringent tariffs put in place, companies have moved out of those areas, but into a lot of the time other emerging markets rather than the U.S.
Still, even with everything that happened with tariffs, you would expect margins to have been worse. Not only did they improve, but estimates are that they keep going higher. Does that peak? Are you surprised that margins have held up as well as they have?
I am a little surprised, especially when you look at inflation that hasn't really come through. The tariffs, you look at them at the outset and you think, okay, either they have to pass on these as price increases or the margins will take a hit. And neither of those stories has really come to fruition in a big way. I think part of it on the inflation side is nobody wants to be the first one to increase prices. So you kind of wait and see how the tariff story shakes out, wait and see what your competitors do. But on the margin growth side, I think it's a lesson to not underestimate the innovative capacity of businesses to adapt to a changing marketplace.
As we get into this year and we start to see the effects of the one big beautiful bill come to fruition, how additive do you think that's going to be? The tax sort of carrots that have been offered by this administration, this Congress?
I think it could be a pretty important tailwind, and it's also front-loaded in the front half of the year, which is helpful. On the consumer side, it's looking like we're going to get a pretty robust tax refund season, and I think that's especially helpful coming at a time when the labor market appears to be softening a little bit, and consumers really could use that little extra boost.
So given those two kind of opposing forces, can the broadening out that's been happening in this equity market continue, where you have small caps holding up pretty well, the equal weighted does well, the more sensitive cyclical parts of this economy, can they continue to perform?
I think they can, yes. Looking at this, transformational technology that is AI, at the end of the day, these powerful technologies, the benefits eventually accrue to the end users. So far, most of the beneficiaries from the trade have been the producers of AI. And I think eventually, as the productivity works its way through the economy, the end users, which is small caps and companies in other countries, can benefit.
All right, Kelly, been great having you on. Hope we can get you back in here soon. Kelly Covley there of Manning and Napier. Let's get a check on what's going on in the markets right now. We have seen the benchmark indexes drop slightly. Now they're up slightly, with the S&P 500 gaining 0.1% to 6940. The NASDAQ up almost 0.2% at 25,119.
Let's look at some of the single stocks that are moving at this hour. Oracle climbing, having its best intraday session of the year, up nearly 10%. D.A. Davidson upgraded the shares to buy from neutral, saying OpenAI is set to exceed investor expectations in terms of model performance, and that is good news for Oracle.
Novo Nordisk said it's suing Hims and Hers for making knockoffs of its obesity medicine, even as Hims and Hers scrapped plans to sell the copycat version of the pill.
And other pharma news, Eli Lilly is set to buy Orna Therapeutics. That is a $2.4 billion cash deal to expand their portfolio beyond obesity treatments.
Coming up, KKR's leaders see Arctos eventually growing into a $100 billion business following their acquisition of the company. We'll bring you part of Dani's interview with KKR's CFO and the CEO of Arctos next. This is Bloomberg Open Interest.
KKR's co-CEOs told Bloomberg that their acquisition of Arctos Partners is key to helping the firm capitalize on two growing business lines. They added that the deal will also strengthen the company's position as a dominant institutional sports investor. I caught up with the KKR CFO Rob Lewin and Arctos CEO Ian Charles about their agreement following the announcement last week.
Anytime we look at strategic M&A, Dani, we're going to have a really high bar, as you can imagine. And for us, there's really three attributes that we look at. In a lot of ways, non-negotiables. Let me take you through them quickly. Number one, need to be really big addressable markets that move the needle for us, and we got to believe we can be world class. Let's look at Arctos. In the sports business, big asset class in its own right today, growing at double-digit rates. Arctos is by far the world leader. Second part of the business, GP Solutions, about providing liquidity and growth capital to other alternative asset managers. Arctos already a top player there, big space. And then finally, what I think we can create together in secondaries, the credibility, the relationships that Ian and his team have in that marketplace, combined with our industry expertise, our access to capital, we think that we can build a world leader there over time as well.
I got to just say, just if I can jump in, just because I'm listening to Rob and I'm like, what a successful business you got there, Ian. It's not like you're stressed. You don't need to sell yourself. You're young. Succession isn't a problem. So why not stay independent? Why become part of KKR?
You and I have talked about the complexity of the private markets industry, how that industry is changing and maturing. When we started Arctos 5.5 years ago, our goal was to serve the best operators and owners in sports, and then to serve the best operators in private markets. And to really do that, we have to have capabilities that span insurance, wealth, data, global perspective. And as a 5.5-year-old firm, we've done a really good job, and we've built a really innovative platform. But the potential that our team has to really help transform and innovate in these markets is really only unlocked in a partnership like this. So we're really excited about the vision that we're going to be able to create and build together that wouldn't be possible for either of us on our own.
For sure.
Yeah, I was going to say also off the back of that, I mean, people have looked at this deal and they're like, KKR is adding sports. That tends to be the big headline. Of course, you're a leader in this space, but I wonder how much of that, Rob, goes beyond sports into secondaries and into GP solutions too.
For sure, it's all three. And what we told our shareholders this morning is we believe together we're going to be able to build a $100+ billion business. And frankly, if we didn't believe that, we wouldn't have done the transaction. I think I speak for Ian. He would agree with that. If he didn't think that we can do that, I don't think he'd be interested in this partnership either.
That was part of my interview with KKR CFO Robert Lewin and Arctos CEO Ian Charles. Let's get to our main reporter on this story. It is Bloomberg private equity reporter Allison McNeely. And Allison broke this story long before they even confirmed this. Allison, first of all, fantastic reporting on this. They were talking about some of their justification for it. But what is the overall change this brings to KKR by now adding Arctos in?
It brings them into two of the hottest areas of private markets where they have been noticeably absent, secondaries and sports. Those are two of the asset classes when I talk to LPs, when I talk to people in the market, they're most excited to put capital in. You know, private equity, very mature business. Even private credit is quickly maturing, not the business it was even 5 years ago. So, you know, big firms like KKR who are always looking for opportunities to grow assets under management, this gives them a real foothold into two areas of growth.
The interesting thing for me, I was interviewing Lawrence Stroll this morning, the owner of Aston Martin and the F1 team, and we're going to play that tape in the close later on today. But Arctos owns a stake in that F1 team, as well as many other professional sports teams. So this gives KKR, what were you saying, Dani, this morning, that they're going to have?
And they have an investment in every major U.S. sports league.
And not only that, by buying Arctos, Arctos is the only investor that's approved to buy in all major 5 U.S. sports leagues, also including Major League Soccer. That gives them a huge starting advantage. You know, we're seeing lots of KKR's peers announce that they're hanging a shingle, they're getting into the sports business, they're launching a strategy. But some of these efforts, without naming names, are kind of early and in name only. KKR now, by buying Arctos, is actively already, you know, money in the ground and an investor, which not all their peers can say.
It's not even just this deal. Over the past week, you had CVC buying Marathon, EQT buys Collar, another secondaries business. What's in the water right now that so much of this consolidation is seeming to happen?
You know, it's really interesting because we've been watching for more like firm level M&A like this for a few years now. I think what we're seeing is the culmination of a few different trends. Obviously, it's been hard to raise money over the past few years since interest rates have been higher. People are selling fewer assets, so they're returning less capital to investors. That kind of gums up that whole flywheel of money going out and money coming in. So smaller firms, they might look around and say, you know what, I think I can grow faster and better as part of a bigger business, or maybe I just don't want to be out here on my own.
Is there any, I know that the whole point, or part of the point of the Trump administration was to reduce regulation, and they've been applauded for that by big players in finance. But is there any pushback, regulatory pushback, to any of these tie-ups?
As far as I'm hearing, not really. That could obviously change. I haven't gotten a huge sense of that. Certainly with the KKR Arctos, Dani's great interview from last week, they said they're very confident they're going to get league approval. For this particular deal, that's the biggest hurdle. There are all sorts of rules related to whether or not you can be an owner of a sports team within the different leagues. And they are very confident, as they told Dani, that that's not going to be a problem.
So in terms of regulatory pushback, when two of the biggest finance companies in the world come together, the only thing that may stop them is like a game master. That's hilarious, right?
I mean, this is a really interesting question. Yeah, I mean, so far, I haven't heard anything about any of these asset management tie-ups, encountering any regulatory scrutiny. But who knows? That may change in the future, especially if we see more people getting together.
So you also had on the same day that KKR announced this, they also had their earnings. We've gotten all the private capital earnings players coming out. Apollo was this morning, and they talked just about their huge book, how much they're lending. We were talking to Silas Brown about this morning, but I always think of this quote in the FT, this story where an anonymous person at Apollo goes, "We're becoming a bank and it sucks." Like, is that how we should be thinking about Apollo right now, that it's just transforming itself into just kind of a plain vanilla lender?
I think Apollo would say, and Mark Rowan would say, and he said in earnings this morning that, they are becoming a dominant lending force on the street, and they are taking on the banks. I don't know if they themselves would call themselves a bank, but they would say that they are a provider, a robust, reliable, worthwhile to consider provider of capital outside of the Wall Street banks. And certainly the growth of Apollo's lending business over the past few years has just been enormous. They're doing about $300 billion in annual lending now, as my colleague Laura Benitez noted with her earnings coverage this morning. And, they're really just so far ahead of all their peers. They're so dominant in that space.
But we want, at the end of the day, if you're an investor, or more importantly, if you're a policy holder, you want these to be safe, reliable businesses, because the big worry with this business is that they're taking an insurance company and using that money that they need to pay people in the event of a catastrophe to invest in their private assets.
Yeah, absolutely. And that is a very real thing. All of these alternative asset managers, as they've acquired insurance companies, they have changed the investing profile. They are moving beyond traditional publicly traded stocks and bonds into private assets. They say that they are excellent managers of risk, and that by doing this, they're actually getting insurance policyholders a better return, a better result than they would get if they were just with your vanilla insurer. But skeptics of this strategy say, hey, we don't really know how these assets are actually performing because they're marking them themselves. There's not as much transparency as, say, on a public exchange. So we certainly saw a lot of those jitters come back through last week with the sell-off in software and AI. Whether it was on the private equity side of the house or the private credit side of the house, all of these firms saw their stock price hit last week because people are saying, hey, what's in your portfolio? Like, what don't we know about? And
well, today Mark Rowan told us.
Yeah.
Zero software.
Yes.
Well, nearly zero, to be fair. But even that would be remarkable, because this was a pretty loved sector for private equity, right? You could see why. Cash flows, there's recurring revenue, it's subscription, low margins. Is this a really big rethink for a lot of the industry players as software is going to be seriously threatened by AI?
I think at this point, I don't know if it might be too early to say that they're totally rethinking the sector, but I think certainly what we've heard coming out of the major firms of the past week is they are distancing themselves from the sector. We've had all the major firms say, hey, Mark Rowan said near zero. KKR, I believe, said around 6 or 7% last week. Don't quote me on the exact number, but in that 6%. Ballpark, they're all saying we're below 10%.
I think Aaron Getty said something similar to us too when he joined us.
Yeah, it's all below 10%. We don't have major exposure. We've done a full audit of portfolio, the exposure, the risk that we do have. We're comfortable that it's properly underwritten, and that's always the case until it's not, right? Like, I think it's probably too early to say, but it's a very interesting thing to watch because it is a change in tone from what we saw a couple years ago.
Allison, thank you so much for joining us. And again, fantastic reporting. Thank you. Looking forward to having you back on the show soon. That's Bloomberg's Allison McNeely. And for more stories on the deals world, make sure you tune in to my new Bloomberg Deals show every Wednesday, 12 p.m. New York time. We're going to track the power players, major moves, and capital flows shaping global markets. Bill Ford of General Atlantic will be our key guest on this coming Wednesday. So
I'm very much looking forward to that. Yeah. I will sit here off stage left and watch that
As long as you don't heckle.
program. No, I'm really looking forward to seeing Bill Ford on the Deal Show Wednesday at noon. Still ahead, a bullish outlook and defiant CEO, activist investor Stephen Wood joins us to discuss his push to overhaul the Swatch Group, which owns Omega, among other brands. This is Bloomberg Open Interest. Going to check on the stock market right now. Just about an hour into the trade using the move function. We see breadth actually to the downside. So 200 winners, 300 losers or thereabouts. And yet we're adding 10 points here. That's because NVIDIA is one of the winners. And it is powering higher right now, up more than 3%, adding more than 15 points to the S&P 500. You also have Oracle right now up almost 9%, adding 2.5 points. So Oracle continues to gain strength. On the downside, Apple is a loser, as well as Amazon, Micron Technology, Merck, and MasterCard. When we come back, we're going to talk about the company behind Schick Razors and Banana Boat Sunscreen. This is Bloomberg.
Edgewell, the parent of brands like Hawaiian Tropic and Wet Ones, is cutting its profit outlook after weaker than expected sales, including a slowdown in its core shaving business. Earnings still, though, surprised on the upside, and the company says the revised outlook reflects a major business sale, not softer demand. Joining us now is Edgewell President and CEO Rod Little. Rod, thanks for joining us this morning. When it comes to some of that downgrade, can you just lay out for us where exactly it's coming from and what is the sentiment outlook if it's not coming from consumer sentiment?
Yeah, good morning, Dani. So first of all, the headline there is wrong, actually. We beat the sales outlook for the quarter. In fact, we had a beat in our fiscal first quarter, which is October 1 to December 30, by a full point on organic net sales. We beat on profit as well. We beat on cash flow, and we held our guide for the full year. That headline is being driven by a sale that we did. We closed last Monday. We sold our FemCare business to Essity for $340 million at a premium valuation. But it's the timing of what we guided to before had FemCare in it, and now what's being reported has FemCare out of it. And that's the only difference. Organically, we were ahead. And so we're seeing consumers hang in there. There's a lot of desirability for our products. The growth rate in our categories, both domestically here and abroad, is hanging in there despite everything you read in the news cycles.
So, and nonetheless, the shares are down 5%. Is that, do you think, because investors don't quite understand the numbers yet, Rod?
I do think there's a little bit of that in there, Matt. You know, early in the day, in the pre-trade, a lot of that is bot electronic trading that happens just based on the print headline. It's very confusing. We just finished our earnings call. We'll share this out. The analysts will put their reports out, and I think you'll see very consistently coming out that it was a good, high-quality quarter in terms of beating what was expected top and bottom, and it'll work its way through. It's just the territory we live in. What we do know, though, is that the FemCare sale for us is a real positive. We sold our most dilutive segment in business at a premium to the whole company valuation. And what we're doing with that cash is we're reducing leverage. It gives us more optionality, flexibility for the future as we go forward.
Well, and frankly, the shares had come up pretty strong, Rod. I'm looking at your stock, and from the bottom in December into into the Friday close, you're up 30%. So, I mean, it's no solace to those who've been in the stock for longer. But if you got into that, maybe it was a bit of a buy the rumor, sell the news story. What about those longer term shareholders? Over the last 5 years, the stock is still down 42, 43%. What do you tell those who've been holding on for a while now about the recovery that you plan?
Yeah, look, it's been a tough period. Our sector's down in total, if you go back over the last year or so, where most of that decline has happened. And I think what you look at a company like ours, there's a question around global growth rates and demand, right? Potentially slowing. We've had inflation. We've had tariffs come in. It's not an excuse, but for example, this fiscal year we're in right now, the tariffs are meaningful. It's 10% of my EBITDA this year after we mitigate for the tariffs is still hitting the bottom line that we have to offset. The consumer right now is not open to pricing most places, very sensitive to pricing. So it's up to us to do the good work, to go create the cost offsets, to navigate that and manage through it. We are really excited actually about the future and our ability to drive growth, expand margin, and build value for our shareholders. The other thing that's out there is you come through very dynamic, challenging periods, and there's a flight to quality in that moment. And in consumer products, that flight to quality is bigger, more scaled companies. You know, we're a couple $2 billion revenue. We're not 80 or 90 like some of our competitors, and they just have more levers to navigate through this. So I think over time that normalizes, but in this moment we've been in, I think that's the other thing that hits a company like ours.
Would you want to take this moment to get bigger, Rod? I mean, I know you just, again, sold your feminine care business, but would you look at maybe acquiring other consumer brands to give yourself more scale and compete?
Look, our focus in the near term is very much around winning with the brands and the portfolio we have. We are scaled globally across the brands you see on the screen right there. So shave, grooming, sun, and skincare. We have IP, technology, know-how, and the global scale in these categories. So I don't think we need to be bigger to win and be successful now that we have these categories as the core portfolio. We just need to build brands, products, and messaging that consumers love and resonate with as we go forward. And we think there's a lot of room for growth, not only in terms of these being good categories to be in, but our ability to be successful and win share in these categories. So that's the focus. And I think from here, you know, we're excited about where we're going.
Rod, there does seem to be this really big movement to have cleaner products. And I have to say, especially in a thing like sunscreen and any sort of like that type of care, Asia seems so far ahead. I was just in Japan over New Year's, and I literally took a whole aisle of sunscreen and just dumped it in my bag to bring home. Because if I'm not mistaken, the FDA just hasn't approved a lot of other types of sun care and sunscreen. What is going on with that? Why is the U.S. so behind? And then how do you, as an American company, keep up and compete with innovation happening abroad?
Yeah, it's a great question, and it's one that's very nuanced in terms of depending on where you operate and buy your product. It can be quite different, as you call out. The FDA here in the United States controls the monograph that says what active ingredients you can use and not use in sunscreen. So we abide by that. We're very happy with our safety record, the quality, and how we craft and build our products to be very much in line with the FDA standards. We're the leader here in the U.S. with Banana Boat and Hawaiian Tropic. If you look outside the U.S., our formulations in many cases are different. The active ingredients that you can and cannot use, not only in Asia, but also in Europe, are different. And so we do some local manufacturing and production so that the formulas that you buy outside the U.S. may be different than what we sell here. Same brand name, same quality standards, same regulatory approach, but just a different ingredient list depending on where you live.
Hey, Rod, I'm wondering about the subscription business because you've done so well with that. How is it looking in the last quarter, and what do you expect this year?
Yeah, I think the subscription business is still on a net decline in terms of where it's gone from the peak back coming out of COVID, but it's still a meaningful part of a business. So for a brand like Billy, it's an important part of the model. And, you know, subscribe and save, whether it be a direct-to-consumer channel that we run, or Amazon, or a Walmart.com, a Target.com, subscribe and save is something we're seeing actually have some resiliency as it goes forward. Definitely part of the model. And Billy's a brand that continues to grow share. That's the brand we activate the most with subscribe and save and subscription. And it's grown every period since we bought it.
All right, Rod, great to get some time with you. Really appreciate you joining us. Rod Little there is the president and CEO of Edgewell. Coming up, an American activist is pushing to shake up a Swiss watch giant, Swatch. It just got a little bit harder as investors appreciate the work the watchmaker is doing. Stephen Wood joins us next to tell us why he's still in this fight. This is Bloomberg Open Interest. American activist investor Stephen Wood is on a one-man mission to overhaul the Swatch Group, but that mission is getting a lot harder. Last month, the Swiss watchmaker surprised markets with a bullish outlook that sent the heavily shorted stock soaring. Just as Wood's push for a board seat enters its second year, Swatch's CEO has nominated a new board member, signaling to shareholders to trust him and not side with the activists. Well, we're lucky enough to have Stephen Wood with us now at the desk. Great to have you. We've all been reading about your travails here, and I wonder, first off, what you think about staying in this fight as the stock appreciates.
I think the watch industry is for sure getting better. I share the enthusiasm of the company. The unfortunate truth is market share has collapsed from 40% to under 25% last year. And I think that investor reactions to the board member and the results, well, first of all, it's the most shorted stock in Europe, so that says quite a bit. But investors' reaction to any small step away from the status quo has been positive. I share that enthusiasm. I think status quo for the last 20 years has not served the company well. And all I wanted to do is bring independent perspectives to the board. So the shortest board member has been there, I think, for 14, 15 years. And most of them have been there for 20 to 30 years. I'm on a board myself. 6 years into it, you are no longer independent. You love the people you work with. You don't challenge them as much, much less 15 to 30 years. So to me, the company generates over 90% of its revenue outside of Switzerland, and it tries to keep the board only in Switzerland. I think it pays to have some diversity of viewpoints in that boardroom, and I think the market agrees with me.
And you've been very clear. You said this is not a hostile act, but of course the company is trying to portray it as that. So how do you try to push for these changes? And I guess, are you trying to work with the company? How do you find that balance of making changes but not be hostile, as it were?
It's a great question, Dani. We call ourselves constructivists because we're always trying to work with them. 9 times out of 10, the CEOs love us to come in the boardroom because we're there to help them. In this case, they've decided that any alternate viewpoints are sort of adversarial. I sort of regret how that has gone for them because really this is not about anti-family. I think the family is extremely important for the future of Swatch. It's just not the only opinion. And so since this campaign has started, many former Swatch managers have reached out to me. They all agree with what I'm doing, which is more viewpoints matter than just 2 members of the family. And so perhaps they take that personally, and maybe I don't even blame them, but this is sort of not anti them. I've always reached out to them every single step of the way, offering an olive branch, trying to come in and talk with them. And let's just say some of the replies have been less than polite.
Let's talk about your biggest problem with this company's performance. I'm looking at margins that are barely above 2%, right? Inventories that are bulging, stock price that's down more than 40% from its peak in 2023. What's the specific problem that you have if you had to choose one with Swatch performance?
So the CEO likes to say they're an industrial company. And they really need to be both. In the world of smartwatches, we saw this in quartz again. Their father saved them from the quartz crisis. The only thing that works in this industry is the premium to luxury segment. It has pricing power. It's CAGR'd at 10% over the last 25 years. All the other segments are like pushing rocks up the hill. And so they have Omega, they have Harry Winston, they have some crown jewels. Breguet used to sell as much as Patek Philippe. And the watch resale values used to double in 2010. Now they get cut in half after you buy one. So who wants to buy one? Almost no one. So the luxury participation, Matt, is where they've really lost a lot of market share. And the CEO likes to think that, we're only focused on luxury and he needs to be an industrial company. I think if you look at Ferrari, they are both. You have to be both. You have to innovate, but then you also have to have a scarcity-driven model. The buyer today almost only cares about the residual value of his timepiece. If it's getting cut in half tomorrow after you buy it, they're not showing up to your stores.
So one of the criticisms that the Hayek Swatch has lobbed at you has basically been you're not Swiss and you don't live in the country. Why would you push back and say that that's not an important factor here?
92% of the company's revenue is generated outside of Switzerland. And in fact, some of their problems, Dani, have been actually the American market. I've heard great things about their American presence, the managers here. The problem is so in their higher end, like Breguet and Blancpain, they have like 2 stores. And so they've really missed the opportunity, which America drove post-COVID. America drove the watch world. And strangely enough, even post-tariffs, it's actually getting even stronger because residuals are going up. And so I think having an American on the board might not be such a bad thing, given they're not participating in the strongest market in the luxury watch space.
You mentioned innovation, and there hasn't been much in the luxury watch segment in the last number of decades, right? Even as we all start to wear Whoop bands and Oura rings and data tracking devices of all sorts and shapes. Why haven't they, partnered up with one of these companies to put fitness trackers in their, stainless steel or white gold bracelets? Why haven't they come up with more innovation beyond like better movements?
It's really a great question. It's one of the proposals that I sent privately into them. It sort of seems like a no-brainer. I see more and more people wearing, just like you, a watch and a Whoop or some type of wearable. And really, what the watch says a lot about you, or it says a lot about the milestone that you celebrated when you got that. And so for me, I always want to wear a mechanical timepiece, but I want the data. I don't know why, Matt, they're sort of ignoring it. They're continuing to innovate like they did in the 90s, which is to try to make a new mechanical movement to try to get the old collectors back. The problem is that's not how the modern watch buyer buys watches anymore. And I hate to say it, this sounds sacrilegious. It's not about the mechanical movements anymore. It is about the fashion and the residual values and the influencers who are wearing it.
So if the Hayek family digs in and you can't get these proposals passed, what's the next move? What do you do from here?
So we've already taken them to court to pursue the last annual meeting. I've talked with 75% of the law firms of the country. They're very optimistic. We will win that. We will continue to not go away. And look, I actually want the company to move in the right direction. I share some of the optimism that the CEO shares right now. And so we are long-term committed investors. And actually, the more they move in the right direction, the happier we'll be along the ride with them.
By the way, just curious what you think about the collaborations they've done with their other brands. So you've got Swatch makes a Speedmaster in 12 different colorways, and now they make a 50 Fathoms as well.
I'm wearing the 50 Fathoms collab, actually.
Very, very cool.
I mean, I love it. I think it's great because Blancpain, unfortunately, has become less relevant in today's marketplace. And so it expands the awareness fairly dramatically. The only critical feedback that I have on it is sometimes the company is really emphasizing Moon Swatch over the Speedmaster Omega, which has 10 times the price point and much better margins. And so I think they need to have a bit of balance between expanding awareness and cultivating the exclusivity of Omega.
Stephen, we're going to have to end it there. We really appreciate your time today. Fascinating conversation.
Thank you both.
That's Stephen Wood, founder of GreenWood Investors. Coming up on the show, we're going to set you up for the trading week ahead. There's payrolls, there's CPI, an especially busy pipeline. We'll have that for you next after this break.
Now look at what's ahead for the markets this week. Today at 1:30 p.m., Fed Governor Chris Waller kicks off a busy week of Fed speak. Tuesday, U.S. retail sales data rolls out, plus earnings pick back up with Ford, Coke, and Marriott. Wednesday, we'll get the U.S. payrolls report and earnings from Mickey D's. Thursday, another round of jobless claims. And Friday, the latest CPI data. Plus, I'm going to Disney World.
Oh, wow, that's the highlight.
For me, that's
For me, it would just be like getting somewhere warm away from the frigid cold that is New York. Let's get more on this week's data. Stuart Paul of Bloomberg Economics joins us now. Stuart, an unusually busy week because we had the delay the jobs data. One other twist in the data is NEC Director Kevin Hassett coming out and saying maybe the jobs numbers are going to be lower. How did you read that? Is that expectation setting? Is it just his big outlook, do you think?
Has he seen the jobs numbers?
So beyond seeing the jobs numbers, something that I'm sure he's been read in on is that there's going to be an adjustment of the birth-death model, which helps to set expectations for the flow of monthly jobs that we'll be getting throughout the rest of 2026. So the birth-death model is what the Bureau of Labor Statistics uses to approximate how many firms have been created, how many have gone bankrupt, and so how many net jobs as a flow have been created each month. And that serves sort of as a baseline beyond which the survey data helps to inform the BLS about how many jobs were created.
Or lost.
Or lost.
As is the case with the manufacturing sector.
That's right. I mean, persistently, jobs lost to the manufacturing sector.
But we're trying to turn that around, right? So that's why I look at that. That's why I look at that number. We lost 72,000 manufacturing jobs in 2025. That number is probably going to look worse after this.
That's right. So the birth-death model, what it helps to do is determine how many jobs are created on a monthly basis. It has been propping up payrolls by about 30,000 a month. So what I think NEC Director Hassett was doing was reacting to the adjustment of that model. No longer will it be propping up payrolls inappropriately. Instead, we should see a much slower monthly pace of job growth. We think in January just about 15,000. And Matt, to your point, when we look specifically at certain industries, we're going to see slower job growth. We're going to even see job losses in industries like manufacturing, which is going to matter a lot as we go into the midterm elections in November.
How are you thinking about the CPI data we're going to get?
Well, I think that one thing that's most interesting in CPI is when we disaggregate services and goods. Services, I am not worried about basically at all. We see basically zero wage pressures, and we see zero inflation pressure emanating from the labor market, and we should get a lot of disinflation from shelter. When we look on the goods side, we do still see some tariff pass-through in things like electronics and recreation goods. So there should be a little bit of concerns there. And what I'm most worried about on the goods side is that I expect that there's going to be a little bit of beginning of the year repricing that exceeds the norm. So we're going to see some residual seasonality, about a 0.3% month-on-month print for both headline and core.
All right, so watch out for that inflation. Stuart Paul of Bloomberg Economics, thank you very much for joining us. Coming up tomorrow, Joanne Feeney of Advisors Capital Management, Ann Maletti of Allspring, plus the CEOs of Duke Energy and Medicus. This is Bloomberg Open Interest.